Look, something just happened in the silver market that most people completely missed. And I'm not talking about some minor price fluctuation or technical indicator. I'm talking about a genuine inflection point that could determine whether silver explodes to new highs or crashes back down to levels we haven't seen in years. The price action over the past few weeks has been absolutely wild. Silver surged to within striking distance of its all-time highs, touching levels around $32 per ounce, before getting absolutely hammered back down. And here's what makes this so critical. This exact pattern has played out before in silver's history, and what happened next changed everything for investors who were paying attention. Let me show you what's really going on beneath the surface, because the mainstream financial media is completely missing the story. They're focused on the day-to-day noise, the headlines about Federal Reserve policy or inflation data. But the real action is happening in places most investors never look. And understanding this could be the difference between positioning yourself for massive gains or watching from the sidelines as one of the biggest moves in precious metals history unfolds. First, let's talk about what just happened technically. Silver hit a major resistance level that it's been testing for months. This isn't just any resistance. This is a level that represents the psychological ceiling where institutional traders have been consistently selling. Every time silver approaches this zone, massive sell orders appear seemingly out of nowhere. The volume spikes, the price gets rejected, and retail investors who bought near the top get shaken out. But here's where it gets interesting. The selling pressure this time around was different. Instead of the usual gradual decline after hitting resistance, silver got absolutely crushed in a matter of days. We're talking about a drop that wiped out weeks of gains in just a few trading sessions. That kind of violent move doesn't happen by accident. It's orchestrated. And when you see orchestrated moves in the silver market, you need to ask yourself, who benefits? The answer takes us into the mechanics of how silver actually trades. Most people think the silver price is determined by simple supply and demand for physical metal. But that's not even close to the full picture. The vast majority of silver trading happens in the paper markets, specifically on the COMEX exchange in New York. And on the COMEX, the amount of paper silver that trades dwarfs the amount of physical silver that actually exists. Think about that for a second. Traders are buying and selling claims on silver, contracts that represent silver. But most of these contracts never result in actual physical delivery. It's a paper game. And the players with the deepest pockets can move the price wherever they want it to go, at least in the short term. And right now, those players are making a very specific bet. The commercial traders, the big banks and institutions that deal in massive quantities of silver contracts, have been building a short position that's absolutely enormous. We're talking about a concentration of short positions that historically has preceded major price moves. But here's the twist. These same institutions are simultaneously accumulating physical silver through different channels. They're shorting paper silver while buying physical metal. What does that tell you? It tells you they're playing both sides of the market. They're suppressing the paper price to shake out weak hands and create panic selling, while quietly accumulating the actual metal at discounted prices. It's a strategy that's been used in precious metals markets for decades, and it works because most investors don't understand the difference between paper and physical markets. Now let's zoom out and look at the fundamental picture, because this is where things get really compelling. The supply and demand dynamics for silver are unlike anything we've seen in modern history. On the supply side, global silver mine production has been essentially flat for years. The easy-to-mine deposits have been exhausted, and bringing new mines online is incredibly expensive and time-consuming. Meanwhile, existing mines are dealing with declining ore grades, meaning they have to process more rock to get the same amount of silver. But the demand side is where the story gets explosive. Industrial demand for silver is surging, driven by technologies that didn't even exist a decade ago. Solar panels require massive amounts of silver, and the global push toward renewable energy means solar installations are growing exponentially. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure, medical devices, water purification systems, the list goes on and on. Silver is being consumed in industrial applications at a rate that far exceeds new supply. And here's the kicker. Unlike gold, which mostly sits in vaults after it's mined, silver gets consumed. It's used up in industrial processes and never recovered. Once it's gone, it's gone. The above-ground stockpiles of silver that existed for decades have been steadily drawn down. Some analysts estimate that the available above-ground silver inventory has declined by over 80% since the year 2000. We're running out of the buffer that used to absorb supply shortages. But wait, there's more to this story. Let's talk about what central banks are doing, because their behavior is absolutely fascinating right now. While everyone focuses on central bank gold purchases, which have been at record levels, something else is happening with silver that's flying completely under the radar. Several countries have been quietly building strategic silver reserves, recognizing that silver is a critical industrial metal essential for national security and technological advancement. Think about what that means. If silver becomes scarce, countries that don't have adequate reserves could find themselves at a severe disadvantage in manufacturing everything from weapons systems to telecommunications infrastructure. The geopolitical implications are enormous, and when governments start competing for a finite resource, prices tend to go in one direction, up. Now let me connect this to something that affects you directly, especially if you're thinking about retirement security. The traditional 60-40 portfolio of stocks and bonds that financial advisors have recommended for decades is facing unprecedented challenges. With interest rates volatile and stock valuations at historically elevated levels, many investors are looking for alternatives that can preserve purchasing power and provide a hedge against economic uncertainty. This is where physical precious metals come into the picture. And if you're sitting on retirement accounts worth $100,000 or more, there's a strategy worth understanding. I put together a comprehensive guide on how gold IRAs work, covering how you can get physical precious metals into your retirement account without triggering tax penalties. It's completely free, and you'll find it in the description below. It walks through the mechanics, the rules, the potential benefits and drawbacks. Worth checking out if this is relevant to your situation. All right, back to where silver is headed next, because the technical setup right now is absolutely critical. After getting rejected at resistance and selling off hard, silver is now testing a support level that has held multiple times over the past year. This is a make-or-break moment. If this support holds and silver bounces, we could see a rapid move back toward the highs. But if it breaks, we're looking at a potential cascade lower that could take silver down to levels that would shock most investors. So which way is it going to go? Let's look at the evidence. The Commitment of Traders report, which shows the positioning of different types of traders in the futures market, reveals something fascinating. The commercial traders, who are typically on the right side of major moves, have been reducing their short positions. That's significant because it suggests they're less bearish than they were just a few weeks ago. Meanwhile, the speculative traders, the hedge funds, and money managers have been cutting their long positions, which is typically a contrarian indicator. In other words, the smart money is getting less bearish while the dumb money is getting more bearish. That's exactly the setup you want to see before a major move higher. But there's more to consider. The US dollar, which typically moves inversely to precious metals, is at a critical juncture. The dollar has been strong, supported by higher interest rates and safe haven flows, but there are cracks appearing in the dollar's strength. The federal deficit is exploding, with the government running trillion-dollar deficits as far as the eye can see. The national debt is approaching levels that many economists consider unsustainable. And while the Federal Reserve has been trying to maintain a hawkish stance on interest rates, the economic data is weakening. At some point, the Fed will be forced to pivot back to easier monetary policy, and when that happens, the dollar could weaken significantly, and a weaker dollar is rocket fuel for precious metals. But let's talk about something even more important than short-term price movements. Let's talk about the structural changes happening in the global monetary system, because this is the real story that will drive silver prices over the next decade. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several other countries that have recently joined or expressed interest in joining, are actively working to reduce their dependence on the US dollar for international trade. This isn't some conspiracy theory or fringe idea. These are official government policies being implemented right now. China and Russia have been settling bilateral trade in their own currencies for years. Saudi Arabia, which has priced oil exclusively in dollars for nearly 5 decades, is now accepting yuan for oil sales to China. The United Arab Emirates is exploring similar arrangements. This is a fundamental shift in how global commerce operates. And here's why this matters for silver. As countries move away from the dollar, they need alternative stores of value and mediums of exchange. Gold is the obvious choice, which is why central banks have been buying gold at record rates. But silver, with its dual role as both a monetary metal and an industrial commodity, becomes incredibly valuable in this new paradigm. It's money that also has intrinsic utility, which makes it uniquely positioned. Let me give you a historical parallel that might help put this in perspective. Back in the late 1970s, silver went on one of the most spectacular runs in financial market history. In January of 1980, silver hit $50 per ounce, up from around $5 just a few years earlier. That's a tenfold increase in a remarkably short period. Now, the circumstances that drove that move were unique, involving the Hunt brothers attempting to corner the silver market. But the underlying conditions, high inflation, currency instability, geopolitical tensions, those conditions are remarkably similar to what we're seeing today. Adjusted for inflation, that $50 peak from 1980 would be equivalent to over $150 in today's money. Silver is currently trading at a fraction of that level. Now, I'm not predicting that silver will hit $150, but I am saying that the potential upside is enormous if even a fraction of the conditions that drove the 1980 move materialize again. And there's another historical parallel worth considering. In 2011, silver surged to nearly $50 per ounce again, driven by concerns about the European debt crisis and quantitative easing by central banks around the world. That move happened in just a few months, catching most investors completely off guard. The people who positioned themselves early made fortunes. The people who waited until silver was already at $45 and bought near the top got crushed when the price subsequently collapsed. The lesson from both of these historical episodes is that silver moves fast and violently. When the conditions are right, silver doesn't gradually climb higher. It explodes. And by the time the mainstream media is talking about it, by the time your neighbor is asking you about buying silver, it's usually too late to get in at good prices. The opportunity is now, while silver is still consolidating, while most investors are uncertain, while the price is being suppressed by paper market manipulation. But let's address the bear case because it's important to consider both sides. The argument against silver right now goes something like this. The global economy is slowing down, which will reduce industrial demand. Interest rates are higher, which makes non-yielding assets like silver less attractive. The dollar is strong, which pressures commodity prices. And the technical picture shows silver failing at resistance, suggesting the path of least resistance is lower. These are all valid points, and they explain why silver has pulled back from its recent highs. But here's what the bears are missing. They're focused on the short-term cyclical factors while ignoring the long-term structural changes. Yes, the economy might slow down in the near term. Yes, interest rates might stay higher for longer than expected. But none of that changes the fundamental reality that silver supply is constrained. Industrial demand is growing, and the monetary system is undergoing a historic transformation. The bears are also underestimating the impact of investment demand. Right now, investment demand for silver is relatively muted. The big surge in silver ETF holdings that we saw during the pandemic has reversed, with investors pulling money out of silver funds. But that's actually a contrarian indicator. When investment demand is low and sentiment is poor, that's typically when the best buying opportunities present themselves. And when investment demand eventually returns, which it will when the macro conditions shift, the impact on price will be dramatic, because the physical market is so much tighter than most people realize. Let me tell you about something that's happening right now in the physical silver market that should concern anyone who's bearish. Premiums on physical silver coins and bars have remained elevated, even as the paper price has declined. In a normal market, when the price drops, premiums should compress as demand weakens. But that's not happening. Dealers are reporting strong demand for physical silver, with premiums staying stubbornly high. That tells you there's a disconnect between the paper market, where prices are set, and the physical market, where actual metal changes hands. This disconnect can only persist for so long. Eventually, the paper price has to converge with the physical reality, and when that convergence happens, it's going to be violent. We've seen this movie before in other commodities. When the paper market loses credibility and investors demand physical delivery, prices can gap higher in a matter of days or even hours. The silver market is particularly vulnerable to this kind of squeeze because the amount of paper silver outstanding is so large relative to available physical supply. Now let's talk about the mining sector, because what's happening with silver miners is another piece of this puzzle. Silver mining stocks have been absolutely destroyed over the past few months, declining even more than the silver price itself. The major silver mining ETFs are down significantly from their recent highs, and many individual mining companies are trading at valuations that imply silver prices well below current levels. This is classic capitulation behavior, where investors throw in the towel and sell at any price just to get out. But here's what's interesting. While mining stocks are getting crushed, the fundamentals of the mining business are actually improving. Many silver miners are generating strong cash flows at current prices. They've cut costs, improved efficiency, and strengthened their balance sheets. The disconnect between mining stock prices and the underlying business fundamentals is as wide as I've seen it in years. And historically, when that gap gets this wide, it closes violently to the upside when sentiment shifts. The smart money knows this. Insiders at several major silver mining companies have been buying stock in their own companies, a strong signal that they believe current prices are too low. Institutional investors who focus on value have been quietly accumulating positions in beaten-down mining stocks. These aren't retail investors chasing momentum. These are sophisticated players with long-time horizons who understand that the current pessimism is creating opportunity. Let's zoom out even further and think about the mega trends that will drive silver demand over the next decade. The transition to renewable energy isn't a maybe, it's happening. Governments around the world have committed trillions of dollars to decarbonization efforts. Solar power is a key component of that transition, and solar panels require silver. Lots of silver. Each solar panel contains about 20 grams of silver, and global solar installations are projected to grow exponentially over the next 10 years. Do the math. If solar installations triple over the next decade, which is a conservative estimate based on current government commitments, that represents hundreds of millions of additional ounces of silver demand per year. Where is that silver going to come from? Mine supply isn't growing. Above-ground inventories are depleted. Recycling can only provide a fraction of what's needed. The only way to balance the market is through higher prices that incentivize new supply and ration demand. And solar is just one piece of the demand puzzle. Electric vehicles are another massive driver. The average electric vehicle contains about 1 kilogram of silver, compared to about 15 grams in a traditional internal combustion engine vehicle. As EV adoption accelerates, which every major automaker is betting on, silver demand from the automotive sector will surge. Then there's 5G infrastructure, which requires significantly more silver than previous generation wireless networks. Medical applications, where silver's antimicrobial properties make it irreplaceable. Water purification systems in developing countries. The list goes on. The point is this. Silver isn't just a monetary metal or a speculative trade. It's a critical industrial commodity that's essential for the technologies that will define the 21st century. And the world is running out of it. Not in some distant future, but right now. The deficit between supply and demand has been growing for years, and it's only going to get worse. So back to the original question. Which way is silver headed from this critical turning point? Based on everything we've discussed, the technical setup, the fundamental dynamics, the positioning of different trader groups, the structural changes in the global monetary system, the evidence points strongly toward a major move higher. But, and this is important, that move might not happen immediately. Markets don't move in straight lines, and silver is notorious for shaking out weak hands before making big moves. What we could see is further consolidation, or even another leg down to fully flush out the remaining bulls and create maximum pessimism. That would set up the perfect launchpad for the next major rally. The key is to not get shaken out during that process. If you believe in the long-term thesis for silver, and the evidence supporting that thesis is overwhelming, then short-term volatility is just noise. It's an opportunity to accumulate at better prices, not a reason to panic and sell. Think about the investors who bought silver in 2008 during the financial crisis. They had to endure a brutal sell-off in late 2008 when everything was getting liquidated. Silver dropped from $20 to $9 in a matter of months. But the investors who held on, or better yet, bought more during that panic, were rewarded with a move to nearly $50 over the next 2.5 years. That's the kind of opportunity we might be looking at right now. The setup is there, the fundamentals are there, the technical pattern is there. What's missing is the catalyst, the event or series of events that shift sentiment and brings buyers flooding back into the market. That catalyst could be a lot of things: a major geopolitical crisis, a currency crisis, a default by a major financial institution, a supply disruption at a major mine, a short squeeze in the paper market, or simply the realization by institutional investors that silver is dramatically undervalued relative to its fundamentals. We don't know what the catalyst will be or exactly when it will arrive, but we do know that when it comes, silver will move fast. The opportunity to position yourself at favorable prices won't last long. And the difference between getting in early and chasing the move after it's already started could be the difference between life-changing gains and mediocre returns. Here's what I'm watching closely in the days and weeks ahead. First, that support level I mentioned earlier. If silver holds above that level and starts to build a base, that's a strong signal that the selling pressure is exhausted and buyers are stepping in. Second, the US dollar. If the dollar starts to weaken, that removes a major headwind for precious metals. Third, the commitment of traders' data. If we see commercial traders continuing to reduce their short positions while speculators remain pessimistic, that's an extremely bullish setup. Fourth, physical market indicators. Are premiums staying elevated? Are dealers reporting shortages? Are mint sales increasing? These are signs that physical demand is strong even if the paper price doesn't reflect it yet. And fifth, the mining stocks. If silver mining stocks start to outperform the metal itself, that's often an early signal that a major move is coming. Miners tend to lead the metal at major turning points. The bottom line is this: silver just hit a major turning point, and the evidence suggests the next big move is going to be higher, potentially much higher. But that move will likely be preceded by more volatility and uncertainty designed to shake out weak hands. The investors who understand what's really happening, who can see through the short-term noise to the long-term fundamentals, are the ones who will be positioned to profit from what could be one of the biggest moves in precious metals history. The question isn't whether silver will eventually break out to new highs. The question is whether you'll be positioned when it happens.